Hello, everybody. Welcome to Monday Morning Must-Knows. My name is Merlin Rothfeld. Here are several things to pay attention to for the upcoming trading week. Now, last week we talked about the unemployment data being so critical, and boy, was it. We saw a tremendous amount of volatility, and all of a sudden those Fed fund futures for the next FOMC meeting started to surge up, and it looks like the high probability is we're going to get 75 basis point increase in a couple of weeks. But that's not going to happen this coming trading week. So let's talk about what's happening this week. We start things off with earnings, and I've got 52 companies. Oh, yawn. 52 companies. Don't waste my time. I'm telling you, trust me, it's important, but you got to wait till the tail end of the week. We start things off on Tuesday because Monday's got nothing going on. Tuesday brings us PepsiCo. Wednesday, you've got Delta Airlines, Fastenal, and Infosys. And then, drum roll please, Thursday kicks in with some green-colored text. You've got JPMorgan, Morgan Stanley, and ConAgra brands. The green represent financial firms, the major banks around the world, well, at least in the U.S. Friday brings us even more banks. You've got Citigroup, Wells Fargo, US Bancorp, BlackRock, PNC Financial, Bank of New York Mellon, and UnitedHealth Group. So this is a tremendous amount of financial firms kicking off earnings season. So if you're trading things like XLF, the ETF that represents the financial firms, expect volatility. Don't know which way it's going to go. Could go up, could go down, could go sideways. But now the probabilities increase that you're going to see big volatility based off what these financial firms say, not only about themselves, but about the market going forward. Now, let's dive a little bit deeper. We've been talking about central banks and reserve banks talking about raising interest rates. The U.S. has been leading that charge, and we'll see what happens in a couple weeks in our markets. But New Zealand will be coming out with an announcement. As you can see here, they're expected to go from 2% to 2.25%, a 50 basis point increase. That should happen Tuesday at 10 p.m. Eastern Standard Time. Now, this is important because we are in this keep up with the Joneses kind of world right now where most of the central banks around the world are raising rates to fight what? Inflation. Well, there's only a couple that have not done that. We'll talk about those in future lessons. But inflation is the major talk track for pretty much every economy around the world. If inflation is out of control, economies are out of control and may suffer for it. So let's see. What are some things that could help fight inflation? Raising interest rates. Oh, check, we're doing that. What else could we do to help fight inflation? Reduce money supply. Okay, great. So what do we do there? We sell the bonds, at least the Fed will be doing this, selling the bonds they purchased, taking that money and putting it back, removing it from supply, putting it back to the ledger where they created it from anyway out of thin air. Now let's see. If we're actually raising rates, we make the dollar more attractive, but we're removing dollars from supply. So what does that do to the price of the dollar? It causes it to skyrocket. And lo and behold, that brings us to our next topic, which is the U.S. dollar. As you can see here, we've had a tremendous rise in the U.S. dollar over the past year or so, year and a half. Going back to May of 2021, you can see the dollar was under 90. Now, we've almost hit 108. This is a huge surge up. Now, you're probably thinking, who cares? I live in America. Big deal. Doesn't bother me. It should bother you because the stronger that dollar gets, the more difficult it is for the U.S. government to pay off our debt. That's number one. But more importantly, it's more difficult for anybody outside of U.S. borders to buy U.S. goods and services. For example, let's say I'm a European and I really want to buy some U.S. cotton. Great. I'll go out and I'll buy cotton. But now if I convert my euros to dollars, I'm getting fewer and fewer and fewer for my euros, meaning my purchasing power as a European or as a Russian or as a Japanese citizen is declining more and more. So it becomes less attractive to buy U.S. goods and services, which does what? It could hurt our economy. So this is a major factor to look forward to. Also, as the dollar rises, commodity prices should start to take a hit. Now, as we talk about inflation, we're looking at record inflation right now in the U.S. we haven't seen for 40 years. So what might stop that? Well, the basis for CPI, which is that basket of goods and services, right? So it's a basket of products that we buy, and that's what's measuring inflation. Now, of course, there's consumer price index, there's producer price index, and a couple other measurements. But if the basis for that basket is made up of commodities, we're talking corn, wheat, soybeans, lumber, cattle, copper, gold, silver, if those commodities decline significantly in value, that could certainly pull down inflation. And if inflation does decline, then all of a sudden our Federal Reserve may not raise as aggressively. So you can see this chess game unfolding. That said, we see an incredibly strong dollar, which should be hurting commodities. Is it? Let's take a look. Let's start things off with a list of different commodities that have been impacted by this rising dollar and global demand. We'll start things off with corn. Yes, you want to go get your cereal, looking for some Cheerios? Well, you'll notice that over the past couple of months, it has had a significant decline. It's about 1 month. It's gone from 800 all the way down to a low of 566. That's a decline of 29.19%. That should have an impact on inflation going forward, shouldn't it? Here is wheat. You got yourself some Wheaties, looking for some cereal again. Went from $12.84 to $7.85 in about 2 months. That's a 38.84% decline in the price of wheat. Certainly will have an impact on food. Look at copper. Are you building homes? Copper is one of the major components of new home construction. It's gone from $4.57 all the way down to a low of $3.27, a slide of 28.49%. That might help the housing market. You look at soybeans. Soybeans have got some $17.84 all the way down to $13.02, a slide of almost 27% in under a month. Natural gas, looking for heating expenses. Of course, we're in the summertime, not that big of a deal, but there is a lot of natural gas consumption and exporting. It's gone from $9.66 all the way down to $5.32. That is a 44.9% slide in the value or cost of natural gas. These commodity prices are tanking, and it's not just the ones I showed you. Lumber is plummeting. Cotton is absolutely getting decimated right now. Now, what does this mean for you and I going forward? It doesn't mean anything right now unless you're trading these commodities. And I'll be honest, the futures markets are a great place to trade, but be very careful because each of these commodities, corn, wheat, soybeans, all the different grains and metals, all have very specific contract specifications that you need to be aware of, so get educated first before you start trading those instruments. But there is a lot of opportunity. It also means that down the road, maybe not this month, but in a couple of months, maybe near the end of the year, we should see these commodity prices taking a bite out of inflation. And if that happens, then maybe the Federal Reserve can start to become a little bit more proactive, be a little bit more aggressive, and not raise rates as much. Maybe lower rates? Whoa, getting ahead of ourselves now. But just know that right now, commodity prices may have a significant impact on the markets going forward. That, my friends, is Monday Morning Must-Knows. We'll see you next week.